Welcome back, traders. The final quarter is underway, and with the US dollar having lost around 13% against the major currencies such as the euro and the yen since February's peak, questions are rising about whether there will be any last-minute recovery phase. Well, Fed rate cut expectations have been the main bearish driver, and futures markets are currently confidently pricing in at least 2 rate cuts. But what is uncertain is whether policymakers could still act more aggressively in the coming meetings, and that will probably depend on upcoming employment and inflation numbers. So this week's non-farm payrolls report, the ISM business PMI figures, and the JOLTS job openings could all provide some extra clues. However, with the risk of a government shutdown looming in the coming days, it's still uncertain whether data releases from government agencies such as the non-farm payrolls report will be released on time or whether there will be a delayed release. Elsewhere, the Reserve Bank of Australia's policy announcement on Tuesday and Eurozone's CPI inflation figures will be closely watched as well. So in this video, my chart analysis will focus on dollar yen, euro dollar, and Aussie dollar, and starting first with dollar yen and the US non-farm payrolls report. Well, expectations are for a soft double-digit employment growth of 51,000. The unemployment rate could remain steady at 4.3%. So that may not, if expectations are correct, that may not be an ideal jobs release that the Fed would like to see. It would still signal a weakening jobs market and therefore could make additional rate cuts necessary. However, since rate cuts are more or less two more rate cuts are already priced in, any downside significant negative revisions could increase the odds for a bold 50 basis point rate cut, in which case dollar yen could stage a more aggressive downfall. From a technical perspective, I wouldn't rule out additional decreases because the price has failed to cross above the 150 round level, and the technical indicators down here are all pointing downwards. However, the risk is not currently on the bearish side yet, and I think that we still have a couple of important support levels which could protect the market. First of all, the 200-day moving average could come into view around 148.40. It could prevent additional declines. Then below that, the 147.35, 146.50 zone could also act as a safety net against steeper declines that could reach the 144.35 zone, which coincides with the 23.6% Fibonacci retracement level of this down leg over here. Now, in the event of a positive surprise in the numbers, which could suggest that perhaps the Fed should stick with a normal 25 basis point rate cut, so we could see dollar yen regaining some ground, perhaps the 50% Fibonacci level of 149.35, and the 150 psychological mark could challenge any price increases. If not, then the rally could stretch towards the 151 and 151.75 zone, where the 61.8% Fibonacci mark is located, and then higher than that, all the eyes will turn to this key resistance trend line coming from April at 152.55 at the moment. Now, looking at euro dollar and eurozone CPI inflation numbers, well, projections are for inflation remaining more or less steady, slightly above the ECB's 2% target. Such results would not be very concerning and would still support the ECB's stance to keep interest rates steady. It would mean that the ECB is still on the right path, and perhaps any positive increases in inflation could also support this case. Probably the central bank would like to avoid any rate cuts in case inflation accelerates. Now, from a technical perspective, we can see that the price has found a key support zone near 1.1660. It managed to rebound here, but its rebound doesn't really look currently very attractive. The 20-day moving average is adding some pressure around 1.1725, and the technical indicators down here cannot really support a clear bullish signal, bullish bias, since the RSI is still below 50 and the stochastic oscillator is close to 20 but has yet to rebound clearly. So probably investors would like to see more meaningful moves, probably a break above 1.1785 and 1.1825 could boost sentiment, likely driving the price towards the 1.19 level or even higher towards the 1.20 and 1.2050 territory. And then above that, the support broken trend line could attract attention near 1.2155. Now the downside, in the event of inflation numbers coming much lower than expected, triggering speculation that perhaps rate cuts could come back into play sooner than expected, then the price could break the support around 1.1660 to test the 1.1590 zone where the price managed to pivot last month. Then below that, the 1.15 psychological mark could try to protect the market ahead of the 1.14 level and the 200-day moving average, which is currently at 1.1328. And finally, looking at Aussie dollar and the Reserve Bank of Australia's rate announcement, we don't expect any surprises. Interest rates could remain steady. And that's because inflation has started to show some signs of stickiness, so the central bank has been signaling a more cautious approach towards rate cuts. From a technical perspective, again, as in the case of euro dollar, the recent rebound in Aussie dollar is not really looking very bullish. It's not very convincing since the price is still below its 20-day moving average, and there are no any candlestick signals over here that could increase confidence about a more meaningful rebound. And looking at the technical indicators, although the stochastic oscillator is trying to rebound near 20, the RSI is still below 50. So overall, that suggests that traders are not feeling very confident about a significant rebound in the coming sessions. Looking to the downside though, the 23.6% Fibonacci retracement level of this up leg managed to post last week's decline near 0.6540. If it fails to hold this week, we could see a decisive downfall towards the 0.64 and 0.6415 territory, where the 38.2% Fibonacci mark is located. Don't forget that the Australian dollar is sensitive to any international trade developments, so that could add more pressure, that could make Aussie more sensitive to any downside, to any negative trade news. Now, in the event of a more hawkish central bank, then the price could attempt a close above the 0.65, 17, 0.66 resistance territory in order to retest the 0.6655 zone, where this short-term broken support trend line is placed. Higher than that, then the price could again challenge this strong resistance trend line near 0.6730. So that's everything I wanted to share with you guys. Thank you for watching. We also have the Bank of Japan's Summer of Opinions, which could affect the yen pairs. That could be also a key headline. In the meantime, I wish you have a great trading session, and don't forget to subscribe and like my video for future technical signals. So thank you for watching and see you next time. Bye bye for now.